Good morning. It's Rene, CIO, Single Point Partners. And I greet you on a day where we've now all have been a bit shaken up by the back-to-back 3% drops in the market Monday and Tuesday after a week where the markets were down about 1.5%. So in total, we're down about 7.5% in the last 10 days or so. So it's been a sharp, pretty violent drop. Never comfortable to live through that. Obviously, the markets are reacting to the news that the coronavirus has moved beyond the original focal point in Wuhan in China. And so, as markets very often do, there's been a knee-jerk reaction to sell down some equity positions. Now, our analysis of the selling pressure that we've seen over the last week or so points to primarily speculators, so hot money investors like hedge funds and day traders who are obviously coming out of a very strong year of 30% plus returns in the equity index, and have really at this point used the opportunity to take some profits and, quote unquote, as they say, get out of the way. We have obviously kept a pretty tight reins on the news flow. There is nothing that we've seen or heard at this point that would suggest that we as stewards of long-term investor capital need to follow the hot money crowd. In fact, as has happened in many similar disaster type situations, going back to the original SARS epidemic of 2003, the Japanese tsunami and earthquake of 2011, which happened around March, around this time of the year as well, and then subsequent to that, the multiple debt crises in Europe, obviously the financial crisis, which is kind of on a league of its own, but looking at these major geopolitical events like epidemics, like wars and natural disasters, there is a bit of a playbook, right? Which is that the initial reaction of the market is to overreact. And in uncertainty, in a world where you don't know how onerous the countermeasures will be to contain the disaster, the markets obviously sell off. With all of that said, I think the answer to the question that's in everybody's mind of what should we do in terms of our equity and bond portfolios, the answer is simple. For now, I think we sit tight, we avoid knee-jerk reactions, and we look for opportunities to buy the dip. Okay? The opportunities that these overreactions present, by and large, in the backdrop of a sound, fundamental U.S. economy means that there will likely be further weakness, likely be further selling pressure, maybe another 5% drop, another 10% drop is not out of the question over the course of the next several weeks as the market digests some of these countermeasures that governments are taking to quarantine and isolate the virus. But for us as long-term investors, once again, will likely represent an opportunity to rebalance back up to our target equity weightings. So for now, my friends and clients, try not to spend too much time looking at the news. It's not a fun activity with this kind of a backdrop. But rest assured, we're going to come through this, and there will likely be an opportunity to exploit it and use this as an opportunity to further improve the outcomes of our portfolios. So with that said, I'm available for anybody that has any questions or comments. But that's it for now. Thank you, Rene.